Hey, I'm Daniel Snyder. This is Week in Byte. On this week's episode, I'm joined by David Traynor, CEO of New Constructs and founder of Seeking Alpha marketplace service Value Investing 2.0. We're covering the recent rally and some stocks that David likes at this time. But before we get into the conversation with David, I do want to tell you about an awesome free opportunity that the team at Seeking Alpha has just launched. And it's being offered only for a limited time. It's called the Seeking Alpha User Panel. It's where you are able to speak directly with the team here at Seeking Alpha to provide feedback of what you like, what you don't like, what you wish we offered, and so much more. Plus, they made it super easy to get involved, which is the best part, right? There's a simple form we're going to add to the description of this episode so that you guys can easily find it. And I think it's like 6 questions. We don't like long forms, and I bet you don't either. So go ahead and check that out. And now that we got the housekeeping out of the way, let's dive in with David Traynor. David, thanks for coming back on the show. It's always a pleasure to speak with you.
Thank you, Daniel. It's good to be with you.
So let's start with the macro, right? Are we in a new bull market? What's your take?
I think it's a bear market rally. I think this is a big head fake. I think we're moving into not just a recessionary environment, but a tighter liquidity environment. The quantitative tightening is going to double up in its intensity here in the next few weeks. I think that's going to put pressure on the weaker companies, the zombie stocks as we call them, and that's going to potentially have a real contagion effect on markets. Companies that have been able to sort of survive on super cheap money and super cheap credit and lax lending standards are no longer going to be able to survive, and it's going to hurt some portfolios and probably cause a lot of other selling.
So you're talking about this unprecedented time of liquidity finally starting to get retracted from the $9 trillion balance sheet. And I think the Fed said that their goal is $7 trillion. We're seeing the dollar value just spike. The euro is falling. I mean, are we in a time, though, where we're going to see the Fed actually control inflation to the point where, market pulls back with that? Or will the market rip during this next time?
I think the market's going to have a significant fallback here. I think we got ahead of ourselves in terms of thinking the Fed was going to be a good bit more dovish. I think there's quite a bit more rate hikes that we're going to see. I think we haven't really even seen the effect of these rate hikes. I think the real difference here in what the Fed is doing versus what Feds have done in the past is that they're going really slowly, right? The narrative is we want to raise slowly and we want to lower slowly. Whereas in the past, it's kind of been like, let's punch that inflation in the mouth. Let's raise rates 50, 75, 100 basis points, whatever it takes in the short term to stop that inflation quickly. And then we can quickly bring the rates back down. I think the plan this time with the Fed is to do the opposite of that. I think it's to raise rates as gradually as they can and then leave rates at a certain level for a while, at a time when they know that the policy is restrictive. So that's above 3.2, 3.4%. And then bring them down only after they are sure that they've got a good 3 months of data that inflation is coming down. All that I think is going to be probably a big negative on the market.
A big negative indeed that we're seeing kind of there's a camp of the bears and their camp of the bulls. We're in this time where it feels like not everybody has actually been on one side like we've had for the last 2 years, right? We're seeing the indecisiveness actually become back into the market where it feels like this is an actual buyer and seller's market. This is what makes me think of like, this is the market. Somebody's going to lose, somebody's going to win. Now, I got to ask you, though, because you're talking about the Fed interest rates and how they just rose 2 times at 75 basis points. And knowing that, you raise interest rates, but the economy really doesn't feel it for 6, 12, 18 months out. Do you think in September that we're on the path to have 50 basis points, 75? And then how do you see it going through the rest of the year? Do you have an opinion on that?
I heard an interview earlier today with Philadelphia Fed President Harker, and his comment was, hey, if we raise 50 basis points, don't consider that dovish. It's still pretty hawkish. If you look at, the Fed has raised rates something like 86 times in the last 20 years, and 50 of those have been below 75 basis points. So most of the time, Fed fund raises are 25 or so, or 50, and so 50 is still a high number to raise, and so I think that's probably what the raise is going to be, but that should not be considered dovish. It's still aggressive. It's pretty rare that you see 50 basis point hikes.
Yeah, and we're talking about this time that we've never seen before. And actually, before we just started this episode, we had a quick discussion about employment, right? And so I want to get your thoughts on that. Obviously, we're seeing wage growth still. We're seeing record low employment. I mean, jobless claim numbers actually went down this week. What do you take? Do you think this is going to continue to be a pressure on inflation, that the Fed's going to have to get more aggressive?
Yeah, I think the labor market's in trouble on two fronts. I think we got a lot of people that got used to sitting on the couch with all the fiscal and monetary stimulus we saw for a while, right? I mean, you really only have to teach bad habits once. People think, forget about that. Good habits takes a while, maybe. Bad habits like, hey, I don't have to work, or I can work a lot less, doesn't take long to convince people that that's something they might want to continue doing. And then at the same time, we've got way less immigration. I think we're down of like over 1 million in terms of trend where we were pre-Trump in terms of the number of new immigrants that are able to add to our workforce. So there are two things really bringing the workforce population down. That's a macro headwind that's going to be really difficult to get over. I think that's going to keep wages really sticky.
So are you kind of in a camp that the people that may have retired over the last 2 years, thinking that everything was great and that they were planned accordingly, not knowing that inflation was going to skyrocket like it has, are you kind of in a camp that those people might not come back to the workforce and we're going to see them stay in retirement, immigration low, and actually in a kind of a population workforce issue?
Yeah, I mean that's certainly a possibility. I think that the odd thing is that look, if we see a significant market correction, a lot of them are going to have to come off the bench because I think there's a lot of wealth created in these meme stocks, crypto, Tesla, et cetera. That's illusory and it's going to get lost. And I think the Fed is trying its best not to crush the market too fast to avoid blame for that. In fact, I think the Fed is purposely moving slowly, and they're going to let, really, I think the energy crisis in Europe and Asia be what pops the bubble here. But I do think all that's kind of inevitable, Daniel. I think that we're kind of between a rock and a hard place. In the big scheme of things, right? When stock prices go up, and we've seen that happen a lot. Effectively, what people are doing is they're cashing in on future cash flows, right? The value of a stock is equal to the present value of future cash flows. So when stocks go up, we're cashing in on more cash flow from the future. So we're basically drawing in or cashing in on future cash flows. And when we're doing that, right, that means in the future, there's just not that much left to cash in because we've already cashed it today. And so the expectations are so high for these cash flows to continue, and it's just not going to be there. At the same time, and the worst part of all this is that a lot of capital today is going into wasted opportunities, right? The capital that's going to meme stocks, the excess capital going into Tesla, that should be reallocated to more productive businesses that actually make money and have an opportunity to earn a good return. So when you take into account the fact that we've probably overdone how much we've cashed in the futures cash flows, and we're going into a slower growth environment because we're wasting so much capital on unproductive assets, it's going to be really difficult for investors to make money going forward. I think we're going to be in this environment, like you said, but a little bit more intense, where you got to be smarter about picking stocks.
I wanted to ask you, since you brought up meme stocks, I mean, obviously, we've all been watching it. And the most recent event, obviously, with Bed Bath & Beyond and the Ryan Cohen ordeal and everything going on there, I feel like some investors are just getting tired of having those meme stocks in the market. And like you're talking about, that money and that capital could be better used elsewhere with things that are actively producing productive things for society and the economy. So do you think the SEC is actively doing enough on the meme stock front, or are they just kind of letting it ride and saying whatever happens, happens?
I mean, Daniel, I think we've never seen an age in the world where there's been so much regulatory capture, right? I mean, think about regulators across all industries, whether it's crashes with full self-driving and what happens there and the lack of regulation there. And there's even documentaries on that. And then what's going on with meme stocks and crypto exchanges. Yeah, you wonder. You really do wonder. I wonder, like, what is the SEC thinking? Why are they letting this stuff happen? Like, what's going on? And these are pretty obvious pump and dump schemes where people are saying one thing about their product and the stock goes up and then they sell against that. The gamma squeeze plays. Meme stocks in general. I mean, just I think at some point, maybe what the SEC and their internal discussions, part of what they're saying is that, look, this is a buyer beware market. We're not here to provide insurance against stupidity. People want to be dumb with their money. They want to take risk. It's pretty clear that that's what happens in the stock market. We can't police that because we can't be in a position now where we have to censor what people can say or not say, or determine what's illegal versus just stupid. Stupid's a hard word to use, but it's hard not to use that when you think about the justification and honestly the strategy for a lot of these meme stocks, right? Like, I mean, they kind of came after us big time when we put GameStop and AMC on our zombie stock list, and the logic behind the investments is non-existent. I mean, it's just no, we're going to hold, and we're going to keep buying, or we're going to hold, and that's just going to break everybody else. It's not a strategy. They've got nothing to say otherwise.
Yeah, you're talking about people that are saying the hodl, and they're also calling themselves apes. And I wonder if you have a viewpoint on, what the Fed might think about what's happening within this specific meme stock sector of the market. Do you think they actually watch it and care and think about that?
It's a great question about whether or not they care. They should care, because I think the Fed is responsible. I think the government is responsible in terms of all the stimulus that they've flowed into the economy. They take responsibility for inciting the speculative behavior, for monetizing it, for funding it, right? I mean, if your risk is low, you're willing to take more of it. If you don't see a lot of risk of losing money because you can go get more of it easily, or you don't have to work for money, you're going to probably be more willing to gamble, and you see those gambling returns pay off because so much money's slashing around, it's got to go somewhere. Yeah, I think the Fed, I think the White House, I think Congress, I think they all take some responsibility, should take responsibility for the speculative environment. And when it all comes tumbling down, they should take responsibility then as well. Now, does that mean that individuals are off the hook? No, Daniel. I think at the end of the day, you got to take responsibility for investment decisions you've made. There have been plenty of warnings from our firm, from other firms, whether it's crypto, whether it's individual stocks, that these stocks could go to zero, that these assets could go to zero, could go very low. And so individual investors have no one to blame but themselves. But from a macro perspective, from a societal perspective, I think the Fed does deserve to get a bad grade for what they've incited and what they've encouraged in the stock market.
Right. Yeah. You're talking about the Fed that's created all the liquidity, and people still have to chase yield, and it kind of makes you wonder. I mean, I've had countless conversations with various people here on Seeking Alpha doing these videos of like, why are gold prices not skyrocketing, right? Why is crypto, is it all kind of been meshed and thrown to the wayside? And obviously you're talking about stocks going to zero, but I would like to maybe stay on the positive side and talk about stocks that may not go to zero, and with stocks that you're favoring right now that you're kind of telling your audience. Would you be able to share any of those picks today with our audience?
Yeah, sure. No, there's plenty of stocks. Our focus list long stock has drastically outperformed the market over the last couple of years. So is our short side. But no, what we like are businesses that actually make money and trade at cheap valuations. And it's a really simple formula. We're not trying to chase growth and momentum, and we think that is an overblown game. While it has yet led to some sort of short-term pops and returns for people that's very attractive, we think it's a recipe for disaster. But firms like Kroger, right, trading as if its profits will never grow, while its profits have been growing strongly. We think it's also very positioned as the market leader, well positioned as the market leader in most of every single market that it's in. We like Qualcomm, we like Valvoline, Triple V for those service centers that I think represent basically a shift in America away from working on your car. Nobody works in their car anymore, right? You got to go to some place. And Valvoline's got one of the best, fastest growing businesses, super strong cash flow, and again, a cheap valuation. Similar story with Qualcomm, right? I mean, I think it's got super high returns on capital, a tremendous cash flow, and a cheap valuation when it's very well positioned to continue to grow into a world where we know we're short on semiconductors. We know we're short on semiconductors, right? We need more. Qualcomm's very well positioned to grow into that and beat the expectations baked into the stock price.
Yeah, and that's an interesting point that you bring up too. I mean, I have questions about Kroger you mentioned. I think that's a name that, if I remember right, Buffett and his team actually just exited. So it's really interesting that you bring that one up. But Qualcomm, I mean, we just had an NVIDIA report their earnings, and obviously the street wasn't exactly extremely excited, but I know that's heavy on the data center front and the gaming, right? Gaming has slowed down, crypto has slowed down, and that affected that semiconductor company. But with Qualcomm, the tech here, I think in my notes, you mentioned like the Internet of Things, the edge computing, the cars. It seems like they're in a completely different lane when it comes to semiconductors, correct?
That's right. They're in a lot of growth businesses, and you mentioned a bunch of them. And it's just a great place to be. It's a good place to be. Good place to be positioned. Look, Nvidia was hot during COVID because everybody was playing games because they were sitting at home. But it's also much more cyclical kind of business. Whereas Qualcomm being engaged in Internet of Things, edge computing, these are long-term trends that just mean there's a need for more computational power outside of big data centers or centralized locations, and we know that that's going to continue. Right? The more we use our phones, the more we use our pocket computers, the more we have bandwidth like 5G to send more data back and forth more quickly, the more we're going to want to be able to do computational work on that data. It's a great long-term trend. It's only going to keep going.
Amazing. All right, let's go ahead and leave it there, David. Thanks for taking the time to speak with us today. We always love having you on the show.
Thanks very much, Daniel. Good to see you.
Now, by order of the Peaky Blinders, let's get over to Seeking Alpha's managing editor, Kim Kahn, for next week's Catalyst Watch. Hey, Kim.
Hey, Daniel. Thanks. Unfortunately, I can't do the Peaky Blinders accent for this entire segment, so I'll just go straight into it. Next week is looking very familiar of items on the calendar, meme stocks in the labor market, which dovetails nicely with the conversation you just had. GameStop is going to be reporting earnings. You heard all the talk about the resurgence in interest in meme names, but interestingly, like GME is down about 7% in the last month. Unfortunately, they're probably going to stick with their habit of not doing a Q&A and their earnings call, especially given all the situation of speculation about Ryan Cohen's movements with Bed Bath & Beyond. That would have been really interesting. But Cohen had noted earlier that console game spending is going to be slowing down this year. So that could be a headwind for the fundamentals. But we all know that fundamentals are only a small portion of the GME story. Then we got at the end of the week non-farm payrolls for August, and the consensus is just south of 300,000. But our friends at Pantheon Economics are saying it could well be north of 400,000, given the home-based data that they've been seeing, that high frequency number, and if you also the stabilization in jobless claims. And that'd be another headache for the Fed, which is already seeing financial conditions loosen despite its best efforts.
Yeah, last week we mentioned, of course, this week's Jackson Hole. Obviously, this episode is being filmed before that, and we get Powell speaking tomorrow. I mean, it seems to me, and I think the rest of the market agrees, as long as we continue to see these high numbers on the payroll reports, and I mean, inflation's got to go higher, right? Or are we finally going to find a stabilization? Do you have any thought?
Yeah, I mean, I think that the Fed can only do so much, and one of the main things it can do is tighten financial conditions, and now they're right back where they were kind of before the Fed started hiking, and that's 2.25 percentage point. It's up, so they've got to be frustrated. They're got to hope for a moderating labor market, but I don't think they're getting it. And but as I said, yeah, we're filming this before Powell speaks, but everybody's expecting him to come out really hawkish.
Yeah, but I mean, you keep hearing about the 50 basis points September, 50 basis points September. I mean, it's going to be interesting. I mean, obviously, we continue to also talk about employment staying where it's at is what's probably going to prevent the actual recession from happening, right? Do you think that's part of their soft landing play and they're actually favoring that?
I mean, it does help them out on a soft landing perspective, but I think that their main concern is still inflation, and they just want to get a grips with it. If they can't really even think about like cutting rates in 2023 if they can't get control of that CPI number. So that's their main focus. I think they think that it's nice to have a soft landing, but I think they'd even settle for a bit of a hard landing and a bounce back in this case, given how they were wrong with the transitory call.
Yeah, what a time to be alive. Kim, I've got to ask you, you're a veteran of the industry. I mean, have you ever seen a period like this in the history of the market before for as long as you've been in it?
Not as long as I've been in it. I mean, it's analogous to the stuff I've read about the 70s and the Volcker period. It was just an unprecedented shutdown of a global economy that we saw, and then everybody tried to use the same playbook and just got wrong-footed. And now we're still looking at these numbers and 40-year high at 40-year highs, and yeah, it's something that even the best economic minds can't make of, and there's always going to be another twist coming around the corner.
Yeah, not to mention what's happening in our movie theater industry, but that's for another time. Thanks, Kim. You have a great weekend, all right?
Thanks, you too.
All right, everyone, just a reminder, go take a quick minute to join the Seeking Alpha user panel if you're interested in sharing your thoughts with our team. I don't need to tell you, but this is an awesome opportunity. Imagine if you could share your thoughts with Meta about how they're ruining Instagram. Am I right or am I right? Well, that wraps it up for this week. But before we get out of here, please do us a favor, like, subscribe, follow, comment, leave a podcast rating or review, depending on where you're watching or listening to this. And until next week, I'm Daniel Snyder. This is Week in Byte. Have a great weekend.